Welcome back. In this lesson, we'll briefly discuss the balance sheet. So, as we said in lesson one, it is crucial that the balance sheet stays balanced, right? So we have the equation, which is assets, which are any resources owned and or controlled by the business, equals liabilities, which is any value that we owe, plus equity, which is essentially the business's worth. So this is the whole equation that the balance sheet is based around. Assets equal liabilities plus equity. So it's crucial that it stays balanced because then we know that we've essentially accounted for everything. So while the income statement, like we discussed, is a period of time, the balance sheet is a snapshot in time of the company's financial position, right? So it's one date. So it could be, for example, March 31st, 2023. So ideally, what should happen if you want your company in good financial standing is the assets and equity should increase, and that relationship is proportional, while the liabilities should decrease. And that ensures good financial health of the company, while all of this remains in balance, which ensures that everything is accounted for, and both are absolutely crucial to running a great business. The second one more so because we need to make sure that every transaction is recorded, everything is accounted for. It is the crucial aspect of the balance sheet. So the balance sheet within the assets and the liabilities section of it divides into two parts, right? So in the assets, you have the current assets, which are assets that won't be with us for more than 1 year. And then you have the long-term assets, which are assets that stay with us for more than a year. Then you have the current liabilities where the business owes liabilities, but they'll pay it off within a year. And then you have the long-term liabilities where the business has liabilities, but it goes over a year. So this makes sure that everything is accounted for and the company is in good financial standing, as I said, to whoever looks at it, right? Accountants, bookkeepers, analysts, investors, business owners, basically anybody from even a different department can get a good gauge of the financial standing of the company. So in this slide, we'll go over the most simple and brief example of a balance sheet. So first off, we start by accounting for all of our assets, right? So we have cash for 1,000, accounts receivable, which is money that we are owed for 300. Then we have capital assets, which are vehicles, equipment, buildings. Capital assets is usually any asset that we as a business own for its use, and there's no intention of selling it in a short-term span at least. And it's not something as easily as consumable as maybe supplies. So yes, vehicles, equipment, buildings, once again, things along those lines categorized into that. So that's 700, and we account for all the total assets we added up, and that is 2,000. So now that we have done the assets, now we account for all of our liabilities. So in this case, we have accounts payable for $200, money that we owe, and then we have a mortgages payable for $600 for a mortgage that we owe. Just in simple examples, right? No, these are obviously small amounts, but just to make it simple. So we add the both accounts payable and mortgage payable up, and that gives us $800. So now, after we've done the liabilities, now we move on to the owner's equity. So we have common shares for $300, right? If you're a public company, you're going to be issuing shares out. You're going to be essentially selling the shares, right, of your company. Then we have retained earnings, which are $900, and the total equity adds up to $1,200. So now the total liabilities and equity is the 800 from the total liabilities plus the 1,200 from the total equity. That gives us the 2,000 for the total liabilities and equity. And that 2,000 for the total liabilities and equity equals the total assets number, right? Which is also 2,000. So this balance sheet balances, meaning that we have accounted for everything. And the equation is essentially obvious in this, sorry, balance sheet, right? Where we have the total assets equaling the total liabilities and equity. So I hope this serves as a simple framework for the balance sheet. We'll go over more advanced examples of the balance sheet, what other accounts could be involved, as well as even new accounts and more nuances of the balance sheet. So in the next lesson, we'll be going over the most, I believe, overlooked, but in my opinion, also the most important bookkeeping process, and that is the bank reconciliation. So we will go over that in the next slides, in the next lesson. Thank you for watching, and see you in the next lesson.